Today I would like to analyze UPS, one of the largest shipping companies in the world and one of the worst performing stocks in the last years. We are down around 56% and we're gonna take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is the market cap of 82.67 billion US dollar. This makes UPS the largest courier company in the world by the market cap. We also have a dividend yield of around 6.62%, which is very high, I would say. And we also can see here we had a very good growth rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 84.6 billion US dollar. This was a strong increase around 14% in 2019. So then in 2021, we had again the strong growth around 15%. In 2022, the decent growth around 3%. In 2023, we had the strong decline around 9%. This is something we don't like to see. And in 2024, we had the very slow growth around 0.12%. But still overall in the last 5 years is a good revenue growth, so the check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 5 billion US dollar. This was an incredible growth around 123% from 2019. Then in 2021, we saw the incredible growth again around 114%. So this is related to COVID, more people buying online. Then in 2022, we saw the decrease around 13%, which is understandable because the year before we had the incredible growth. Then in 2022, we saw the strong decrease around 45%. And finally, in 2024, we saw the increase around 22%. So overall, I would say we had a decent growth, but not very good. So it's still a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 5.37 billion. We're going to divide it with the market cap, 82.67 billion. Then we're going to get the free cash flow yield for 2024 around 6.49%. So this is a good free cash flow yield actually, it's over 4%, so the check here. But we can also see the free cash flow yield is lower than the dividend yield. This is something we don't like to see. This means they cannot really pay the dividend with the free cash flow. And if they need to decrease the dividend in the future, I think this can affect the stock price in the negative way as well. So we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here 2025 around 6.3 billion US dollar, in 2026 around 6.5 billion US dollar, in 2027 around 6.6 billion. So let's assume very pessimistic for 2027 around 6 billion US dollar in free cash flow. Then we're going to divide it with the current market cap, 82.67 billion. So then we're going to get a free cash flow yield for 2027 with our free cash flow assumptions. So the number we're going to get would be around 7.25%. So this is a very good free cash flow yield, and I think it's the indication that this company could be undervalued right now. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. So this is a very important number because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 19.1 billion US dollar. We're going to add the short-term debt as well. So the short-term debt is around 1.73 billion. So then we're going to divide it with the current free cash flow, 5.37 billion. Then we're going to get the debt to free cash flow ratio for 2024. This is around 3.87. So this is a decent number. I would say it's under 5. So this means in a little bit under 4 years, we can repay the debt with the free cash flow. So the check here, we like to see that. We can also take a look at the cash on hand, how much cash this company has in the bank. We can see here around 6.32 billion US dollar, which is also a decent amount. So overall, this company has a decent balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. This is the current market cap, 82.67 billion. we're gonna add the debt as well. So the debt is around 20.83 billion. We're gonna take minus the cash. So the cash around 6.32 billion. So then we're gonna get the enterprise valuation for this company. So how much the whole company is worth. So the number we're gonna get would be around 97.18 billion. This number we're going to divide with the current free cash flow, 5.37. So then we're going to get the ratio that we're looking for. The number we're going to get would be around 18.01. So this is a very good number actually. This can be an indication for undervaluation. I think this company can look undervalued right now. We can also take a look for 2027 with the free cash flow assumptions around 6 billion. Then we're going to get a different number as well. So the number we're going to get would be around 16.90. So again, I think this company does look undervalued right now, and it's a check here as well. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. So we like to see that, especially if we think the company is undervalued. So we can see here, yes, this company does buybacks a lot actually. We can see here many years in a row, this company buys back around 2% of their shares. So in 2023, it was over 1%, and in 2025, around 0.47% so far. So I think overall it's something we like to see, and it's a check here. Can UPS stock be a good buy right now? One of the worst performing stocks in the last year. We are down close to 34%. So let's start with the positive about this company. So we had a decent revenue growth in the last 5 years. We also have a decent balance sheet. This means the company doesn't have too much debt and a good amount of cash on hand. The free cash flow yield around 6.49% is also quite good. This can be an indication for undervaluation. With our free cash flow assumptions for 2027, the free cash flow yield would be around 7.25%, which would look even better. Our enterprise valuation to free cash flow ratio around 18.1 is also a very good number. We want to see that number under 25. So this can be again an indication that this company could be undervalued. For 2027, this number is around 16.19, which would look even better. We also have a very high dividend yield around 6.62%, which is very attractive as well. What we don't really like to see is a slow free cash flow growth in the last 5 years. It was also very inconsistent. So overall, I think this company can be a good buy right now. The valuation is quite good at the moment. If you found this video helpful, don't forget to like and comment and subscribe for more content.